One thing that I've noticed this year is that a lot of people are having a difficult time outperforming the market, just this year in particular. And that is because a lot of money is going into only a few companies. And overall, this is causing the market to become very top heavy. This is something that analysts were warning about for a while now. In 2020, there's a New York Times article that says analysts worry about the top heavy stock market. And they mention that a lot of money is going into companies like Apple, only a handful of them. Apple, Facebook, Amazon, Microsoft, and Google. Those are like the top 5 companies, and most of the market's money is going into those companies. Now, it seems like Tesla has kind of taken the place of Facebook, but regardless, we have the same top-heavy issue. It's actually amazing to see how much money is going in to only a handful of companies. Take a look at Microsoft just this year. It's up 53% year-to-date. 53%. Have fun outperforming that. Go ahead, pick your portfolio of high-quality, fast-growing companies and see if it's outperformed Microsoft year-to-date. Likely not a chance, especially on a risk-adjusted basis. This is just straight-up momentum, not much volatility, a couple minor downturns of like 4%, but overall Microsoft has just been going up. Institutions want Microsoft. They want to own more and more of it. Money has been pouring into it. It's now up to $2.5 trillion. That is an enormous amount of money. $2.5 trillion market cap. And this isn't where it ends. We have Apple, the other juggernaut. Apple has taken the throne once again as the biggest company in the world. It has a market cap of almost 2.9 trillion. I think it will be maybe around 3 trillion by the end of this year, early next year, especially if demand stays for their products, which it seems like it will. There's analysts saying that Apple has so much demand, it will just continue to sell its products. They can't even sell all the ones that they have right now. They don't really need to mark down their products, but they do a little, just to get people excited about them. But Apple's on its way to $200. And this is one company that's going to be worth $3 trillion. We have Tesla. Tesla hasn't been a slacker either. Tesla's up 41% year to date. It's had a lot more volatility than Microsoft per se, but the returns have been good, and Tesla has been executing really well. As long as this company continues to execute like it has been, and it still retains the potential of having a robo-taxi network and all of this exciting stuff in the future, Tesla's going to have institutional money pour into it. Tesla has passed a $1 trillion market cap. It's one company. Google has also not been a slacker. This is the one that people underestimate. Ads came roaring back. Google's up 72% year to date with very little volatility. Money has been pouring into this company. It's now worth above $1.9 trillion. It's about to pass the $2 trillion mark. In fact, it's only like $100 billion from it. So it might pass it just in the next couple of days. But Google's another one of the big 5 companies right now. And then the last one we have here is Amazon. Amazon has been slacking this year. It's up only a measly 10%. And this is the worst of the bunch, the worst performer. The worst performer of the top 5 is only up 10%, which is still really good. Amazon is at a $1.78 trillion market cap. The trend is very clear. The market has become very top heavy, where only a few names move the entire indices. These companies are enormous companies, and institutions are pouring more and more money in them. And investors that are investing outside of these big companies are not seeing the same returns. Across the board, many other companies are in bear markets, they're getting sold off, they're having a difficult time. These ones are really pulling the market along with them. Now there's more articles, more write-ups now talking about this issue or whether or not it's an issue, but the fact, this phenomenon of trillion-dollar companies taking over your portfolio and the market in general. If you're outside of these companies, you're outside of the market. They're making up the market. Now, if we look at these companies' weightings within the S&P 500, you can actually see how big of a portion they make up of the overall broader market. The S&P 500 has basically become an index full of top tech companies. That's all it really is right now. It has Apple at almost 7%, Microsoft at 6.3%, and then after that, we actually have Google, because it's broken up between the two. If we do a little addition between GOOGL and GOOG, we have 4.3. So we have Google at 4.3, then Amazon at 3.8, and then Tesla at 2.1. Between just those companies, they make up something like 23% of the entire market. So these companies make up over 1/5 of the market, almost a quarter of it. Your money's going into these companies if you invest in the broader market. Now, if we look at the QQQ, the concentration is much higher. Yes, this index holds 102 companies, so it has over 100 companies, but it's still heavily concentrated into only 5 names. Apple makes up 12%, Microsoft makes up 10%, Google makes up something like 8%, then Amazon at 7.5%, Tesla at 5.5%, and then Nvidia at 5%. Between these 5 and 6 companies, that is 50 to 60% of this entire index. 50% of the index is in 5 companies. This is an incredible amount of concentration. So we have a ton of money going into a few companies, only 5 companies, and those few companies are all performing well, every single one of them. The worst performer is Amazon at only 10%. So they're all in the green, and some of them have performed 40, 50, 70% year to date. So there's a ton of money going into a few companies, and those few companies are performing incredibly well, meaning that if you're not invested in either the market, which holds these companies, or these companies in and of themselves, you've likely underperformed the broader benchmark. If you've invested in anything outside of Google, Facebook, Apple, Amazon, and Tesla, you've probably underperformed the broader benchmark. That is the honest truth here. Now, the question that I think we all have is how long can these few companies, these top 5, continue to perform the way that they have been? This outperformance is crazy, and it's unusually good right now as well. If we look at a technical analysis indicator here, and I'm no technician, so I don't do a lot of technical analysis stuff, but there is one TA thing that I look at, and that is the 200-day moving average. It's called the simple moving average. The 200-day, I think, is the most standard one that technicians look at. What the 200-day simple moving average does is gauge the momentum of a stock. Stocks normally trade at a certain speed, right? The stock price from one year to the next goes up at a certain rate over time. And what this does is average that out. And it determines mathematically if the stock is trading well above its 200-day moving average or below it. And one trend that we see with all of these companies is that they're trading above their 200-day moving average. For instance, Apple is 25% above theirs. This is what Apple's chart looks like. The chart is their price chart, and then we have the 200-day moving average, which is the purple line. And Apple is well above it right now. You can look at the chart. There's the purple line. There is the 200-day moving average. There's a lot of positive momentum in Apple's price. Microsoft is similar. It's 20% above its 200-day moving average. If we look at the chart here, this is what it looks like. Microsoft is above where it normally trades marginally, but look at it against the 200-day moving average. Microsoft almost always is just moving up and up. The stock really has low volatility, and if you were trying to buy Microsoft below its 200-day moving average, you'd have a very difficult time. Over the past year, Google has had a huge price surge. Currently, it's still 15% above its 200-day moving average, which is incredible considering this year. Look at this chart. Google's way above where it normally trades. It's normally pretty close to its 200-day moving average. Right now, it's 15% above, and that comes after a year of outperformance. So Google is still on fire as a stock, but Google clearly has a lot of positive sentiment and momentum in the stock right now. Amazon is a bit of an outlier here. It's only 5%, 4.9 above its 200-day moving average. So if we look at this chart, it does look a bit different. Amazon has flattened out over the past year. It's been somewhat of an underperformer this year. And that actually means that it's probably a better time to buy Amazon based off of the historical technical analysis data. Amazon's momentum has flattened out, and it's done that in the past, and then it goes through huge spikes once things clear up. And I could see this happening again in the future with Amazon. So based on just technical analysis, I would say Amazon so far is the best buy. Tesla is 41% above its 200-day moving average. 41%. That means that there is a lot of positive momentum that's happened over the past 200 days. Tesla's price against the 200-day moving average has clearly spiked up. There's lots of positive momentum, and based on Tesla's history, it could trade down again. This one is far more volatile than the other ones listed. So these 5 companies, aside from Amazon being the exception here with only 5%, they have a lot of positive momentum priced into them. They're all trading well above their 200-day moving averages. And to give that a comparison, the S&P 500, the broader market, is at 9% above its 200-day moving average. So it does have positive momentum, but not nearly to the extent of Tesla or Google or Microsoft or Apple. All of those are way above what the rest of the market is. And that is why those companies are outperforming everything else. Now, whether or not these companies will continue to perform the way that they have been is up for debate, but typically these things don't go on forever. Companies don't have growing positive momentum forever without any type of slowdown or underperformance. It just doesn't happen that way. We can look at a couple valuation metrics. For instance, overall, the S&P 500 has a forward PE ratio of 21.4. But this is a little misleading because if you're comparing this PE ratio against these top 5 companies, you'd want to exclude these top 5 companies' impact on this overall PE ratio. If you were to take out the top 5 companies from the S&P 500, the PE ratio would even drop further. It'd be down to like 18. So overall, the S&P 500, excluding the big tech companies, has a PE ratio of around 18. It's not much above its historical average. Really, the companies that are pushing the S&P 500's PE ratio way above its historical average are the top tech companies. Let's look at a couple of them. Apple's at a 29 PE ratio. Now, I bought into Apple heavily on my other channel with my passive income portfolio when it was at a price of $90 a share. It was trading at like a 20 PE ratio, and I thought this is really dumb. Apple's a way better than average company, and it should be trading above 20. But now it's at almost a 30 PE ratio, and that's with the earnings increasing over time. So Apple's multiple has been expanding like crazy, and I never really predicted it would get to this type of multiple. Right now, Apple's valuation does seem a little steep. So we're getting close to double the market's PE ratio. Now we can go to Microsoft. Microsoft is at a 36 forward PE ratio. It's at a price to sales of 14, which is pretty expensive. In terms of quality, Microsoft is much better than the average company. But as an investor, you're paying double the PE ratio for Microsoft than you are for the rest of the market, the combined rest of the market. That is a very expensive premium, and in my opinion, it can't continue to go up like it has historically. The multiples can't continue to expand forever. There has to be an end to it at some point. Now, moving on, we can take a look at Google. Google is at a 26.25 forward PE ratio, a 28 trailing PE. Both of these are much higher than the rest of the market. Now, Google is above the market company, right? It has a better balance sheet, a better business. It creates more wealth and more revenue. But still, it's trading at a very high multiple, and it's had a ton of positive price momentum already baked into it. Can it continue to outperform like it has? Probably not to the same degree it has over the past year. It might. It could surprise me. But I think that it's been so good for these companies, and the PEs are racing up so high above the rest of the market, that I don't think this can continue forever. They have to grow their earnings faster than the multiples expand. Now we can take a look at Amazon. Amazon is also way above the rest of the market with a forward PE ratio of 53.4. Now, this has came down over time as they've grown their earnings like crazy, but this is still 2.5 times the rest of the market. So they're multiples above the PE ratio of the rest of the market. Amazon is reliant, I think, at this point on growing their earnings for this stock to appreciate. They're not going to appreciate by multiple expansion. So I don't think that Amazon's PE ratio is going to climb after this. I think that investors are hoping that Amazon can grow their earnings. And they do have kind of a tricky earnings. Amazon artificially suppresses their earnings by reinvesting so heavily back into their business. So it might actually be a better buy than it looks, but they really do have to continue growing their earnings like crazy for this to be a good buy. I don't think that people are going to pay up for the same level of earnings from Amazon. Tesla is at a 128 forward PE ratio, and the trailing PE ratio is very telling. This is why I put them both together here on Qualtrim Insights. This software is included with the Patreon, by the way. But the forward PE ratio tells you the analysts' expectations of how much money the company is going to earn over the next 12 months. The trailing PE ratio is based on the last trailing 12 months. So the trailing PE ratio of Tesla, is 349, which is super high, right? They weren't earning a lot of money for what people are paying, but the forward PE ratio, based on their earnings of the next 12 months, is 128. So they cut their PE ratio in half by growing their earnings like crazy. If they continue to do this, the PE ratio will come down, the stock will become a safer play, a safer valuation. But this is multiples above the rest of the market. You're paying a 128 forward PE ratio for Tesla when the rest of the market is trading at an 18. So my basic takeaway here is that a few companies are leading the market. They have a high concentration. They're dictating the overall broader markets. Everybody that's performing well in the indices are in large part because of these 5 companies. The valuations are getting stretched. There's a ton of positive momentum right now. The PE ratios of all 5 of them are either double or triple above the rest of the market. I think that they do deserve a premium, but I'm becoming skeptical of whether or not these 5 companies can continue to year after year perform the way they have forever. I don't think that's going to be the case. We might see some more Facebook type of situations where they start to fall out of favor. In my portfolio, I'm not against big tech investing. Some people say, why do you invest in big tech? You need to. If you're not investing in these top 5 companies, you're going to be having a very difficult time outperforming the market. So I have investments in Google, huge investment in Google. That's been a good one this year. I have Amazon. That's been a kind of an underperformer, but not terrible. I have Microsoft and I have Apple. And I even have some Facebook. So I'm invested in these big companies. The only one that I don't have right now is Tesla. I previously had an investment in Tesla, but I sold it for nearly 100% gain. And I don't think right now is the time to jump into it, in my opinion. So I'm invested in these big tech companies. And then I also have a weighting towards cloud companies. Cloud companies took a beating over the past month. They started to recover a little bit. This is what the chart looks like with my portfolio against the S&P 500. So I'm down about 4% under it right now. I've recovered quite a bit. So overall, that's my thoughts on the subject. Big tech has outperformed almost everything else over the past couple of years. I'm becoming skeptical of whether or not this can continue because these companies, although they have amazing fundamentals, everything looks good right now. And that's when people become really bullish and bid things up in price. If anything turns negative for these companies, the valuations might reset back to normal valuations, which are quite a bit lower than they are right now. So we'll see. I'm not making any real big decisions off of this. I thought I would just highlight this trend going on of a high level of concentration in only a few companies. I think it's becoming a bigger and bigger thing in the market. And I want to know your thoughts on it. So that's my thoughts for today. I'll see you in the next one.